the governor just needs to sit on his hands right now, doesn't he?
I think so. I think the committee has shown a little bit of division, perhaps, with one or two of them thinking rates should rise. But I would have thought that the data that we've seen recently, particularly on retail sales, is such that a bit of waiting to see is probably right. So that's what I would expect this week.
How long can... We have very negative real rates in the UK right now.
Yeah.
Is that sustainable?
In the long run, you'd have to say it would not be, because I don't see how an economy built on savings and investment can operate with negative real rates indefinitely. But we're, of course, still, unfortunately, in a recovery phase from the crisis where the normal rules have been suspended. So I think most people in banks would say they hope that some normalisation of interest rates will occur, because in maturity transformation business, you know, it's a bit difficult with a completely flat yield curve. But I think we understand why the bank has not been ready to move to normalisation yet.
Sir Howard, on this desk on June 24th, June 25th, June 26th, it was all about capital flows and goods and services flows. Give us an update on your interpretation, how flows will be to the United Kingdom. Is a deficit still a great worry and an ever greater deficit?
I personally am concerned about the deficit, and that may be a slightly old-fashioned mindset, because I was brought up in the UK Treasury in the 1970s, you know, when we had constant sterling crises. So I tend rather to focus on that. And I note that we have offset that deficit by significant capital inflows, a lot of them property related. And you can only sell London property to foreigners once. I mean, they may buy and sell it among themselves.
This is a critical issue, isn't it?
And I do think it. So I am concerned, and I think that the rebalancing of the economy, which we're seeing some signs of, with a little bit of improvement in export performance following the decline in sterling, is what we need.